What's going on, guys? It's Jimmy here. We got some major news here right now. This comes here after last week. Fitch analysts, Fitch rating agency, downgraded the U.S. government. Now, yeah, so Fitch had previously downgraded the U.S. government, which is effectively the credit rating of the U.S. government, which is very, very big. Now, Fitch is saying that they may be forced to downgrade dozens of major banks here in the US, which could cause more runs on the banks. It may cause them to even fold, go out of business. It may cause them to, it may cost them millions or billions of dollars even. It may also cause their lending abilities to suffer. It may cause them to, the way they get money through lending, it may cost them more money. And when it costs them more money to be able to get capital, ultimately it'll mean you, the consumer, it'll mean more money to you in return. It means your credit card rates will go up, your auto loans will go up, your mortgages will go up, personal loans will go up. It means you guys will end up spending more money. Interest rates will go up effectively. Look at all the banks here that may be affected. This is going to be major news here. Take a listen.
There may be another downgrade coming for the banking industry. Fitch is warning it may be forced to cut the credit rating of dozens of banks, including big ones like J.P. Morgan. CNBC.com's Hugh Son was first to report the story. He joins us now, Hugh. So what's behind this potential move?
Hey, Mike. So I think just a little bit of context here. So Fitch, back in June, lowered its assessment of the U.S. banking industry's health from AA to AA minus. And there were no rating changes on the bank, so it went largely unnoticed. I think Fitch was actually kind of concerned at the increasing risk that they'd have to cut it another notch. So taking that industry rating from AA minus to A plus, which is one level lower. Now, the problem that introduces, Mike, is that you have four institutions, some of our top-rated credits, including J.P. Morgan and Bank of America, the two biggest banks in the country, that are rated currently AA minus. And you can't have banks rated higher than the operating environment in which they operate. So that would necessitate at least the examination of cutting them from AA minus to A plus. And that would potentially set off a cascade of examinations of the entire universe of banks covered by Fitch. There are more than 70, where you would have to consider cutting some of these other banks, that are rated less than JP Morgan and B of A to maintain the gap between the top banks and the lesser credits, Mike.
I suppose that this is still based on a lot of the issues that we are, have been aware of for months, which is, higher cost of deposits, some deposit flight, taking some unrealized losses on bonds, maybe some deterioration of the economy down the road. I guess the big question for me is, this will matter if it does raise the cost of borrowing for the institutions. Of course, debt and deposits are the raw material for what banks produce, right? So is there any evidence that might be the case?
Well, I think, you would have, obviously the markets are a dynamic thing. I mean, Moody's, cut 10 banks last week, and Morgan Stanley analysts basically pointed out they believe that the borrowing costs for the downgraded banks would increase, and there's even a risk that some of the banks could get locked out of debt markets overall. If you increase the cost of debt issuance, what does that do? That basically increases the pressure on their profit margins, and that's one of the big stories, of the year. I think it's important to point out two things. The reasons, the factors that would potentially push Fitch to do this would be, credit normalization. If commercial credit, obviously we're talking about office loans, if it's worse than they expect, if that normalization is actually worse than they expect, then they would have to look at that. And if the Fed actually has to keep rates higher for longer, then that's something that they would have to look at as a trigger for these potential downgrades.
Yeah, normalization in this case is a negative because we're coming off of such a low credit loss environment. I suppose, the idea of the potential for higher borrowing costs for banks in aggregate is sort of interesting given the fact that regulators are now floating these ideas that smaller banks should rely more on long-term debt. In other words, raise a lot more long-term debt as a capital cushion so that they have it locked up.
Right, and you're running into the possibility that the market it doesn't have a great appetite for some of these lower rated credits. I think the interesting thing for my money, Mike, is that the downgrades from last week were largely small and mid-sized banks. We're talking about J.P. Morgan and Bank of America here, State Street, Boney Mellon, the top rated credits in the country, potentially going down a rung, and the cascade effect that would have.
Yeah, it would be an interesting test of the market's view of those issuers. So we'll have to see how that plays out. Hugh, thanks very much.
And JP Morgan and Bank of America are the two largest banks in the U.S., with JP Morgan with $3.7 trillion of assets just in the U.S. alone. Bank of America, $3.2 trillion of assets in the U.S. alone. So this is a severe, severe thing, because when their basically credit rating gets downgraded, this shows the amount of kind of trouble brewing here in the United States. As we've already seen, 5 major banks fail in the U.S. here this year, worth billions of dollars. 4, I think the lowest one was worth like $5 billion. 4 of them worth double-digit billions. 3 of them worth over $100 billion. 2 of them worth over $200 billion. And 1 multi-international bank, Credit Suisse, which was worth over $500 billion, possibly even in the trillions of dollars, depending on the assets and multi-international assets. It's even hard to track how much that bank was potentially worth. This is a growing concern here, with the Fed potentially even raising interest rates here yet again, keeping them higher for longer and putting more pressure on these banks and their assets. And the problem here is that when you start to downgrade these credits of these banks, it may cost them more money to get capital, and get access to capital. What that ultimately will mean is that you guys will end up paying for it. Banks will start charging you more fees. They'll start charging you to even hold money at banks. They'll start charging you more money to in terms of credit card interest. They'll start charging you more money for auto loans, for mortgages, any type of thing with banks. They'll find ways to get more money out of you if they start losing profitability. And also remember that these banks employ millions of people as well. So the banking system is a huge part of the U.S. economy, one way or another. They're AKA too big to fail. If you've seen the movie or multiple movies in relation to that, they're literally the backbone of the U.S. economy. You go back to the Great Depression or before the Great Depression, when we didn't have the fail-safes in the U.S. economy with the banking and the regulation, the FDIC. Yeah, it's literally too big to fail. And the banking sector and through all the different departments of money and things like that, how many people they employ, how many small businesses and things like that. When you start to see stress and fractures in the banking sector, how many banks have failed this year and had to be engulfed by other banks that had to take on those toxic debt of those banks, which kind of puts stress on those banks as well. Yeah, and now we're going to potentially see the 2 largest banks in the U.S. be downgraded. Now, it's kind of a cascading event here that says there's kind of problems in all of the banks right now. And a lot of this is because of inflation and the Fed having to raise rates due to inflation to try to calm it down a little bit. It just shows you that the whole economy, really the whole global economy right now is just an absolute tough atmosphere. So I'll keep you up to date here. Let me know your thoughts in the comments. If you haven't yet, subscribe down below. Click the bell icon so you don't miss out on any new videos that come out here every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Thank you so much for liking and sharing these videos. Click here to see how Vladimir Putin is testing the US defenses. Or click here to see Biden's new announcement on executive order bans. Click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.